All right, so today we're doing a deep dive on some hidden gems, potentially. We're going to be looking at the Dow Joneses, but we're going to be focusing on dividend stocks that have lagged behind the S&P 500 this year. You might be thinking, lagging stocks? That doesn't sound very exciting. But trust me, this is where things get really interesting.
Yeah, it's all about perspective, right? What the market might see as underperformers could actually be opportunities, for the savvy investor. Think of it like finding those vintage treasures at an antique shop. They might not be flashy, but they hold real value.
I love that. I love that analogy. And our source for this deep dive, an article from the Motley Fool, points out something really important. Less than 29% of S&P 500 companies are actually beating the index this year. So maybe those lagging Dow stocks aren't so unusual after all.
Right. We need to look at the bigger picture. The S&P 500 is trading at a pretty high valuation right now, historically speaking. Forward price to earnings ratio is over 22, and we've only seen that level twice before since 1985. So that's a key piece of context for this whole discussion.
So the market overall is a bit pricey. And within the Dow itself, only 10 out of 30 components are actually outperforming the S&P 500 this year.
Exactly. And to add another layer to that, two of those outperformers, NVIDIA and Amazon, are actually relatively new to the Dow. So that really sets the stage. For our deep dive into why some of these more established Dow stocks might be trailing behind.
So it's like everyone's chasing the shiny new thing and overlooking those solid, dependable companies that have been around for decades. That's where the idea of value investing comes in, right? Finding those companies that might be temporarily undervalued, but still have strong fundamentals and potential for growth over time.
Exactly. Especially when we consider the potential for market volatility. Looking for companies with reasonable valuations and a consistent history of dividend growth can be a really smart strategy. These companies provide a degree of stability and potential income, even if their share prices aren't going through the roof right now.
Makes sense. So which companies are we talking about specifically?
The Motley Fool article highlights 7. Chevron, Coca-Cola, Procter Gamble, McDonald's, Visa, Microsoft, and Nike. Quite a mix, right?
Definitely some household names in there. But they all pay dividends.
They do. And the article gives us a really handy table that summarizes their forward price-to-earnings ratios, dividend yields, and the number of consecutive years each company has increased its dividend.
Okay, let me pull up that table. Wow, some of these dividend increase streaks are mind-blowing. Coca-Cola at 62 years, Procter Gamble at 68. That's incredible. We're talking companies that have been consistently rewarding their shareholders for decades, through thick and thin. To be considered a dividend king, a company has to have increased its dividend for at least 50 consecutive years, which is no easy feat.
It really speaks to the resilience of their businesses and their commitment to shareholder value. Let's start by diving into Chevron. They've got a strong balance sheet, which is always a good sign. But what's really interesting is their low production costs. This means that they can stay profitable, even when oil and gas prices are fluctuating, offering investors a degree of stability. That's hard to find in the energy sector.
Didn't they also mention something about Chevron expanding into low-carbon businesses? It seems like they're trying to anticipate the future and position themselves for a world that's less reliant on fossil fuel.
Absolutely. They're investing in renewable energy sources and technologies to diversify their portfolio and prepare for a potential energy transition. It's a strategic move that could pay off big in the long run.
That's pretty forward-thinking for an oil giant.
Okay.
Next up, we have Coca-Cola and Procter Gamble, both dividend kings, as you mentioned. These are companies that seem to defy economic cycles. People need their sodas and their household products, no matter what's happening in the market, right?
Precisely. They're classic consumer staples. People buy them regardless of the economy, which makes their businesses incredibly resilient. This translates into a steady stream of income for investors, especially those seeking a more conservative approach.
It's like owning a tiny piece of those iconic brands we see everywhere.
Yeah.
Now, on to McDonald's, another company with a seriously impressive dividend track record. They've increased their dividend for 48 straight years and are on track to become a dividend king in a couple of years. What's their secret?
Well, their unique franchise model is a big part of it. They only own and operate about 5% of their restaurants. This keeps their overhead low while generating revenue through real estate, intellectual property, and royalties from franchisees. It's a very efficient model that generates a lot of cash.
Wait, so they're basically a real estate company?
Yeah.
Disguised as a fast food chain? That's brilliant. Plus, everyone knows McDonald's. It's a global brand with incredible recognition and customer loyalty.
Exactly. It's a powerful combination that has fueled their global expansion and dominance in the fast food industry.
Now let's Let's shift gears to a very different type of company, Visa. They've only been increasing their dividend for 15 years, which might seem small compared to the others, but they're known for having an incredibly profitable business model.
I remember reading that they have insanely high operating margins, something about taking a tiny cut of every transaction, crosses through their network. With billions of transactions happening every day, that must add up fast.
Absolutely. That's the power of network effects. The more merchants and consumers use Visa, the more valuable the network becomes, making it very difficult for competitors to catch up. And while their dividend yield might not be the highest, they return capital to shareholders primarily through stock buybacks.
Okay. Can you break that down for me? How do stock buybacks work? Essentially, Visa buys back its own shares from the market. This reduces the number of shares available, which can increase the value of the remaining shares that investors hold. It's a strategy that has worked well for them historically, contributing to their long-term outperformance of the S&P 500.
So it's like they're concentrating the value of the company among a smaller pool of shares. Interesting.
Exactly. Now, let's move on to Microsoft. They seem to be firing on all cylinders. Record sales, high operating margins, a strong balance sheet. And they're not even heavily reliant on debt to run their business.
And let's not forget their huge role in the artificial intelligence space, especially with their partnership with OpenAI. It feels like they're perfectly positioned for explosive growth as AI becomes more integrated into our lives.
That's a key part of their investment thesis.
Yeah.
Their collaboration with OpenAI gives them access to cutting-edge AI technologies, and they're actively finding ways to monetize those advancements across their product portfolio. It's a really exciting area to watch.
Definitely. Okay. Last but not least, we have Nike. Their story seems a bit more complicated than the others. The article mentions that they've actually been the worst performing Dow stock in 2024, right behind Boeing. What happened?
Well, they've hit some roadblocks. Sales and margins have been declining as they navigate the changing retail landscape. The shift towards direct-to-consumer sales has disrupted their traditional relationships with wholesalers.
So are they trying to adapt their business model to this new reality?
Absolutely. Turnarounds take time, and sometimes things get worse before they get better.
But they do have a 23-year history of increasing their dividend. That suggests they have a solid foundation, right?
Exactly. Their brand remains incredibly strong, and they have a fiercely loyal customer base. The question is whether they can effectively execute their turnaround strategy and return to sustainable growth. If they can, their stock could be a bargain in a few years.
It's fascinating how each of these companies has its own story, its own strengths and weaknesses, and it really drives home the point that investing isn't just about looking at past performance. It's about understanding the underlying business and its potential for the future.
It's fascinating how each of these companies represents a different sector, right, and has its own approach to growth and dividends. It really highlights why diversification is so important in a portfolio.
Absolutely. Having that mix of companies with varying levels of risk and potential return can help you reach your financial goals, especially in a market as dynamic as this one. But let's bring this back to our main focus. What's the common thread among these Dow stocks that haven't kept up with the S&P 500 this year? Is there something linking them together beyond just being part of the Dow?
One thing that stands out to me is that they're all well-established large-cap companies. You know, they aren't the flashy, high-growth disruptors that have driven a lot of the market gains lately. They might even be victims of their own success. When you've grown to a massive scale, it can be harder to maintain those sky-high growth rates that investors often chase.
So it's like they've hit a ceiling. They're still making solid profits, they're paying dividends, but they're not generating the same buzz as some of the newer, faster-growing companies. It makes you wonder if investors are overlooking the long-term potential of these stalwarts.
That's a great point. It's important to remember that past performance doesn't guarantee future results. These companies have proven track records, but the market is always looking ahead, trying to predict where the next wave of growth will come from.
It makes me think about the current market sentiment. We talked about the high valuation of the S&P 500 earlier. Is it possible that investors are simply chasing growth stories, driving up the prices of certain companies, even if their valuations aren't justified by their fundamentals?
It's a classic pattern we see in market cycles. There's always an element of speculation and emotion involved, especially when it comes to high-growth sectors or new technologies.
So it's like a pendulum swinging between chasing growth at any cost and seeking value and stability.
Exactly. It's never a straight line. Market sentiment shifts, and what's hot today could be cold tomorrow. That's why having a long-term investment strategy and not getting swept up in short-term market swings is so important.
Right, because if you're constantly chasing the hottest trend, you might end up buying high and selling low, which is the opposite of what you want to do as an investor.
Absolutely. You've got to understand your own risk tolerance, your investment goals, and your time horizon.
Yeah.
If you're looking for steady income and long-term growth, these Dow stocks, despite their recent performance, might actually be quite attractive.
It sounds like it's not about picking winners and losers, but about understanding the market's dynamics and finding opportunities that align with your needs and objectives. So let's circle back to these specific companies and dig a little deeper into their potential for 2025 and beyond. We talked about Chevron's move into low-carbon businesses. That's a big shift for a company rooted in oil and gas production. Do you think they can actually pull it off?
It's definitely a bold move.
Mm.
It highlights the importance of not just looking at a company's current business, but also assessing its ability to adapt and innovate. The energy landscape is changing rapidly, and companies that can't keep up risk being left behind. The question is, can they leverage their existing expertise and infrastructure to become a leader in renewable energy, or will they face an uphill battle against newer, more agile competitors?
It'll be interesting to see how it plays out. Then there's Coca-Cola and Procter Gamble, the dividend kings, known for their stability and resilience. But are they still relevant in a world where consumer preferences are changing so rapidly?
That's the challenge they face. The consumer goods industry is incredibly competitive. Brand loyalty isn't what it used to be. These companies need to constantly innovate, launch new products, and find ways to connect with consumers on a deeper level. They can't just rely on their legacy brands to carry them forward.
They need to prove that they can stay ahead of the curve, anticipate those consumer trends, and create products that people actually want.
Exactly. Their past success doesn't guarantee future success. They have to earn it every day.
Yeah.
What about McDonald's? We talked about their impressive franchise model and their global reach. But can they overcome changing eating habits and concerns about health and sustainability?
It's a valid point. The fast food industry has been under scrutiny in recent years. Consumers are more health conscious than ever before.
It's a challenge McDonald's can't afford to ignore. They have to appeal to a broader range of consumers, including those who are seeking healthier, more sustainable food choices. They've made some efforts to offer healthier options and promote sustainability initiatives, but it's an ongoing battle.
Now on to Visa. They seem to be in a strong position with their market share and profitability. Are there any threats on the horizon for them?
The payments landscape is constantly evolving. There's a lot of innovation happening with new technologies and competitors emerging all the time. Think about mobile payments, digital currencies, and the rise of fintech companies. Visa has to stay ahead of the curve and adapt to maintain its edge.
So even though they're a leader, they can't get complacent. They have to keep innovating. And what about Nike? We talked about their struggles this year and the need for a turnaround. What factors will determine their success or failure going forward?
I think it comes down to a few key things. Can they regain their momentum in the footwear and apparel market? Can they effectively manage their direct-to-consumer strategy while also mending those relationships with wholesalers? And can they continue to innovate and create products that resonate with consumers, especially with the growing competition from other athletic brands?
So there's a lot at stake for Nike and for all of these companies. It's a good reminder that even the most established companies aren't immune to disruption and change.
Absolutely. And that's what makes investing so intriguing. It's not about finding companies that will stay the same forever. It's about identifying those that can adapt, innovate, and thrive in a constantly changing world.
It's about understanding that investing isn't just about numbers. It's about the stories behind those numbers, the people, the strategies, and the challenges that shape the future of these companies. It's amazing how we started by talking about the Dow Jones as this big abstract index, and now we're thinking about these companies as individual stories of, innovation, resilience, adaptation. It really humanizes the whole concept of investing.
Yeah, it's easy to get lost in the numbers and forget that we're talking about real companies making real products and services that, impact people's lives every day. And behind those companies are teams of people making decisions and navigating challenges in a constantly changing world.
And that's what makes investing so fascinating. It's not just about buying a stock ticker. It's about, participating in those stories, becoming a part owner of a business, and having a stake in its success.
Yeah, it's about understanding that your investment decisions have real-world implications. And that's why doing your research, understanding the companies you're investing in, and aligning your investments with your own values and goals is so important.
It's about being an informed and engaged investor, not just, following the crowd or chasing the latest fads. So as we wrap up our deep dive into these intriguing Dow stocks, what are the key takeaways for our listeners? What can we learn from these companies that have lagged behind the market this year?
Well, I think there are several valuable lessons here that apply to investing in general. First, it's crucial to remember that even the most successful companies can face challenges and setbacks. Past performance doesn't guarantee future results. Just because a company has a long history of success doesn't mean it's immune to disruption or changing market dynamics.
It's a good reminder that there are no guarantees in the stock market, and even those blue-chip companies can go through periods of underperformance.
Second, this deep dive has really highlighted the power of diversification. Having a mix of different types of companies in your portfolio can help you manage risk and, potentially smooth out returns over time.
Don't put all your eggs in one basket, as the saying goes.
Exactly. And third, I think it underscores the importance of taking a long-term perspective. The market can be volatile in the short term, with ups and downs that can feel unpredictable. But over the long run, quality companies with strong fundamentals tend to perform well.
It's like tuning out the noise and focusing on the bigger picture. Don't panic when the market dips. Stay focused on the long-term potential of your investments.
Precisely. And finally, this deep dive reinforces the importance of doing your own research and understanding the companies you're investing in. Don't just rely on headlines or follow the crowd. Dig deeper, look at their financial statements, read about their strategies, and form your own opinions about their long-term prospects.
Become an informed investor who understands the forces at play and makes decisions based on, your own analysis and judgment.
Yeah, I think that's a great way to put it. Now, as we wrap up, I'd like to leave our listeners with one final thought. We've talked about how market sentiment can change, how companies can face challenges, and how the investment landscape is constantly evolving. In light of all that, what do you think is the most important trait for success in investing?
That's a great question. It makes me think about all the different approaches we've discussed. Value investing, growth investing, dividend investing. And while each has its merits, I think the most successful investors are those who are adaptable, the ones who can adjust their strategies as needed and who are committed to continuous learning and growth. The market rewards those who are willing to put in the effort and stay ahead of the curve.
I couldn't agree more. So to our listeners out there, keep learning, keep exploring, and keep asking those critical questions. The more you know, the better equipped you'll be to navigate the complexities of the market and achieve your financial goals.
And on that note, we've reached the end of our deep dive. We hope you found this exploration insightful and are walking away with some fresh perspectives on investing in the ever-evolving world of the Dow Jones.
Until next time, happy investing.